guys, welcome back to my favorite channel. Right now I want to say about use the minimum expected return to choose your cryptocurrencies. Now that you've done your pre-holding homework, it's time to discuss holding strategies that can help you achieve your investment goals. Use the minimum expected return to choose your cryptocurrencies after determining your minimum required rate of returns. It's time to do a bit more research for holding cryptocurrencies that have the highest chance for success. In particular, you must research on the average rates of return on your prospective cryptocurrencies, particularly if you plan to buy those that are already being publicly traded. Why? It's because tokens being sold through ICOs don't have past prices to compute average returns with. For illustrative purpose, let's say that after doing your research, you find that the average annual returns on Bitcoin, Ethereum, and Litecoin were 30% to 20% and 25% respectively. If your minimum required rate of returns is 18%, which of the three would you choose? Chances are you'd go for Bitcoin without betting an A-list because it has the highest average annual return at 30%. I wouldn't say it's wrong, but what I can say is that it's incomplete. Why? When comparing actual returns to average returns, they're rarely the same. Actual returns aren't equal to the average, but they tend to be within the range of the computed average in most cases. This means that actual returns can be higher or lower than the computed average by up to a certain amount. To optimize your chance of being able to achieve your minimum required rate of return, you'll need to choose investments whose most conservative estimate or forecast future returns equal or exceed your minimum. And for this, you'll need to compute for the standard deviations, which measure the volatility of returns of how far can you reasonably expect returns for a specific investment to be from the mean or average return computed. Allow me to illustrate this in a way that you can easily understand. Let's say that the computed standard deviations for Bitcoin, Ethereum, and Litecoin were 15%, 3%, and 7% respectively. What do these figures mean? It means that you can reasonably, not perfectly, expect the return for Bitcoin this year to range from 15%, 30%, mean 15%, to 45%, 30%, plus 50%, where 15% is the lowest expected return for Bitcoin for next year. For Ethereum, the annual returns for this year to range from 17%, 20%, mean 3%, to 23%, 20%, plus 3%, and for Litecoin from 18%, 25%, mean 7%, to 32%, 25% plus 7%. Now compare the lowest expected returns for each of the three cryptocurrencies. Bitcoin is 15%, Ethereum is 17%, and Litecoin is 18%. Given your minimum required rate of return, the wise choice would be Littlecoin because its lowest expected annual return for this year is the only one that satisfies your 18% minimum requirement. Without the benefit of standard deviations, you could go for Bitcoin, which has a reasonable chance of registering a lower annual return than your required minimum. And even though its mean or average annual returns the highest, it's also the most volatile with the highest standard deviations, which resulted in the lowest among the low end of the expected return spectrums. Diversity, a very crucial holding strategy that you can apply to practically and financial investments. It means to spread your investment eggs in different baskets so that if one investment basket drops, your other investment eggs won't crack. And more than just investing in at least two cryptocurrencies, you must also make sure that you don't apply your investable funds in cryptocurrencies only. Why? Because Bitcoin, either Litecoin, and other altcoins belong to the same class of financial assets, which is cryptocurrency. There's a good chance that when something happens that concerns or can affect the whole cryptocurrency industry, the prices of all your cryptocurrencies may simultaneously take serious hits. For example, if the Federal Reserve makes a pronouncement that will make it more difficult to transfer funds from banks to cryptocurrency exchange, in won't just be the price of your Bitcoin that will go down, but if you also diversify your investment to other financial assets, you reduce the potential impact of negative events on your total portfolio. Okay guys, until all first for today. See you in the next video. Say bye bye. Bye.